that.
When we look at the internals of the market, we can see a bullish divergence, which is how investors feel versus what they're actually doing. Although sentiment is exceedingly bearish, positioning remains risk on.
If you look at like some just bread and butter sentiment indicators, you look at like AAII, the spread between bulls and bears had gone from extreme bullishness right after the election to the most extreme pessimism that we've seen from individual investors since fall of 2023 when the market was making a significant bottom. It's been a nice sentiment reset, and I think the near term is going to be pretty constructive for equities.
Despite how investors feel over the next 6 months, they are positioning into equities over bonds, reflected by tighter credit spreads. And of those equities, they are positioning into more cyclical, high growth assets versus the defensive ones. And this means thematic momentum trades like crypto and quantum computing will likely continue to outperform. And we can also observe this by seeing that Bitcoin is back above 100K and the amount of stocks making new 1-month highs is increasing. Inflation expectations are basically turning from concerning to less concerning. And this opens up the probability of more cuts. As a matter of fact, one of the voting members touched on the possibility.
If we continue getting numbers like this, it's reasonable to think that possibly rate cuts could happen in the first half of the year.
The biggest macro driver of markets continues to be where inflation is headed. If it's headed lower, even at a slower pace, markets can go full risk on as interest rates fall. If it's slightly higher, markets can still stay bullish, but in industries that have pricing power and lower valuations. We call this cyclical value. The direction of inflation dictates which assets receive the most inflows. In my view, inflation is much lower by the end of 2025 with some bumps along the way, which opens up the rotation between cyclical growth and cyclical value.
First of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. There isn't necessarily a connection between growing faster and more inflation. So I'd say that it's difficult for me to make the case inflation's getting strong.
The correction is more than likely over with. And the asset class most likely to benefit from the Trump administration is crypto. Just remember, most meme coins are scams, but decentralized finance is coming to a city near you.
The president-elect has gone from skeptic of cryptocurrencies to more of a believer and is now reportedly planning an executive order to name crypto a national imperative or priority.
We've had about $36 billion